I have trimmed Microsoft in my dividend growth portfolio and replaced it with two other investments. I want to tell you why I trimmed Microsoft and what I replaced it with. Hi, I'm Dave Van Napp for the Dividends and Income channel. Let me request that you give a thumbs up to this video if you appreciate the content. Subscribe to our channel and ring the bell so that you get notifications of new videos when we post them. Thank you. Okay, first let's review Microsoft and see why I trimmed it. This display shows some important facts about Microsoft. It's the line from my portfolio table that I show in my portfolio videos. Microsoft, as you can see, I first bought it in 2014. It yields only 0.8% now. Moving along to the next red mark, it comprises 8.3% of my portfolio, and it's giving me $107 in annual income. That means that 8.3% of my portfolio is only generating 2.1% of my income. This chart shows why Microsoft has become such a large position in the portfolio and yet is paying such a small percentage of my total income. This shows the price of Microsoft over the last 10 years. I bought it, as we saw, in 2014 first and again early in 2015. And the green line that I've drawn on this price chart, the horizontal connecting line, connects the two dots that show when I bought it. And you can see what's happened to the price since then. It has skyrocketed over the last 7 years. When I first bought Microsoft, it was a legitimate dividend growth investment, yielding around 3%, as I recall, and with a short but steady record of increasing its dividend each year. So I didn't buy it when it was yielding 0.8%. I wouldn't buy a stock now yielding 0.8% because my focus is on income rather than on price. But the rising price of Microsoft has taken down Microsoft's yield. Okay, you probably already know that yield and price are inversely related. As price goes up, yield goes down. That's what's happened with Microsoft. Its yield has slid over the past 5 years. While it used to have a yield approaching 3%, it's now just 0.8%. So as the price has gone up, the yield has gone down. The important thing to remember, though, about that is the number of dividend dollars being paid out by Microsoft hasn't changed. The drop in yield, yield itself is a derivative metric dependent on not only how much dividend is paid out, but also on the price of the stock in the market. If the price skyrockets, the yield falls. That doesn't mean that you're getting, if you already own it, it doesn't mean that you're getting any fewer dividend dollars. It simply means that the ratio of those dollars to the stock's price has gone to a low percentage point. My business plan designates several circumstances that call for possibly selling or trimming a position. This display is a piece of my business plan for my portfolio, and I've highlighted 3 reasons that apply to my decision to trim Microsoft. Reason B is if a stock bubbles or becomes seriously overvalued. That has happened to Microsoft. Reason F is if it sees its current yield rise above 9%, which doesn't apply here, or drop below 2%, which does apply here. Microsoft's yield is 0.8%. And G grows to where it's beyond 8% of the portfolio. As we saw earlier, Microsoft now occupies 8.3% of my portfolio, and that is solely because of its meteoric price rise. This display shows the overvaluation of Microsoft's stock. This price graph is from Fast Graphs, and if you've seen my other videos, you know that Fast Graphs provides fair value reference lines. On this graph, there are 2 fair value reference lines. One is orange, one is blue. And you can, the black line on this graph is Microsoft's actual price. And you can see, and I've drawn red arrows up to show how far above the fair value Microsoft's price has risen. So that triggers one of the 3 reasons that we saw in my business plan to consider trimming it. Those 3 reasons all apply in Microsoft's case, and so I did decide to trim it. On August 4th, I sold 7 shares of Microsoft, received approximately $2,000 for selling them, and lost just $16 in income because of the sale. I never sell a stock unless I know what I'm going to do with the money. My policy in this portfolio is always to be fully invested. So before I sold Microsoft and got the $2,000 for selling it, I'd already decided what to do with the money. And what that is I decided to add to the portfolio's two smallest and newest positions. This display shows the two investments, I would call them stocks, but one of them is an ETF, that I decided to buy with the proceeds from selling Microsoft. The first is Merck, which is a small position that I've been slowly building up. You can see from the colors that Merck is a very attractive stock for a dividend growth portfolio. It gets green ratings on the various things that I show on this slide. Has a nice yield of 3.4%, 99, which is a maximum dividend safety score. Its quality snapshot gets 24 out of 25 points, and it's undervalued. There's not a whole lot more you can ask from a potential stock for a dividend growth portfolio, unless you just want to buy something that has a higher yield than 3.4%. For me, that's fine. The other choice I made was, which you've probably seen a video about, is the ETF from Schwab, ticker symbol SCHD, which is what everybody calls it. Its formal name is U.S. Dividend Equity ETF. That is doesn't have as many green spots on its summary. Yields 2.9%, which is fine for me. My minimum is either 2.7 or 2.8% for investing in something. Its 5-year dividend growth rate stands out. It's been 12% per year. Simply Safe Dividends does not yet score the safety of ETF dividends, so there is no score to report. I haven't figured out yet, although I'm working on it, how to make a quality snapshot for ETFs, so I don't have one of those available either. I will just say that I've studied SCHD in detail, and I believe it is a high quality dividend growth investment. Its current valuation is fair. It's not on sale, but it's not overpriced either. So those are the two choices that I made to replace Microsoft. This display shows the summary of the purchases that I made in those two investments. I basically split the money that I got from selling Microsoft, so approximately just short of $1,000 went into each of these purchases. That got me 13 shares of Merck, and the annual dividend income added from those 13 shares is $34 a year. It also got me 13 shares of SCHD, and the annual dividend income added is $28 for a combined $62 of income. And if you recall, I got $62 in income from buying those two positions, and that compares to the $16 in income that I lost when I sold the shares of Microsoft. This slide shows a summary of what happened when I trimmed Microsoft and added more Merck and SCHD. Financially, I gained about 1% in annual income. My dividend growth rate is going to stay approximately the same across the portfolio. I trimmed the risk that's inherent in an oversized position. Some people say, let your winners run. I understand why they say that, and I do let my winners run, but I do have the maximum size that we saw before in my business plan of 8% of the portfolio. And anytime anything gets beyond that reaches my risk tolerance, and I tend to want to trim those positions. The quality of the portfolio and the safety of the dividends stays the same, and the balance in my portfolio obviously moves toward but does not achieve anything approaching equal weighting. But I trimmed the largest position in the portfolio back a little bit. The $2,000 worth of Microsoft that I sold brought that position size down to around 7% of the portfolio. And I was able to slightly increase two new positions that I'm building, Merck and SCHD. I always like to say that you should invest like you're the CEO of your own business. Perhaps the most important decision that CEOs make are how to allocate capital. That's what I did here. I moved capital from an oversized, overvalued, low-yield position into two investments that are better valued, have higher yields, and have plenty of room to grow in my portfolio. And that's it for this video. I thank you for watching. Please remember to click the buttons, and I'll be back in about a week with my dividend growth stock of the month for September. Bye, everybody.